David Bacher of Corion. It's time to talk about the Corion Report, and we do have a lot of fun every month, David, looking at certainly last month. It wasn't that much fun because it had been a really rough 6 months, the worst in decades for international stock markets. But July, gangbusters. What happened?
Well, Alec, what a difference a month can make. Starting with the US, it gained about 9%, and that's the biggest monthly return for almost 2 years, while the NASDAQ rallied even more. It's astonishing to note that the NASDAQ index, despite all the things we mentioned last month and the fears and the rumblings and the concerns, is now 20% higher than its low. So, talk about a bull with fangs. That certainly was July, was a massive rebound in global assets and particularly risk assets.
Justified?
Last month, if you'll remember on the show, we were warning people to, become too bearish. And we pointed out the fact that over the long term, risk assets go up. And to be underweight risk assets, you probably need a better argument than to be overweight risk assets. But having said that, the economy still has, is slowing down. Inflation is still a worry. And valuations are not cheap. So with those headwinds, we wouldn't, and particularly after the rebound that we had last month, we wouldn't be suggesting to our clients to go overweight. I think there's more volatility going forward. And potentially the best thing is to, stay a bit cautious and not, lots of bear markets have these rallies. Best not to be caught in a bear market rally.
There seem to be almost divergence of thoughts here. On the one hand, the individuals are going heavily into shares. In fact, last month, according to some data that the Wall Street Journal has provided, was the biggest month for buying by individuals since 2014. On the other hand, professionals like yourself are saying, watch out, this could be what is termed a bear market rally. Just explain, if you would, why you feel that we have to be so cautious.
Well, let me touch on the first point. I actually saw some research, and there's lots of evidence that generally retail investors and people in the street, their long-term returns are a lot less than the average benchmarks or institutional returns. And I think that's just sentiment and the psychology of investors. Generally, there's fear and greed in investments. And when you go to a bar and you listen to your friend talk about, how he bought a share that went up 10, 15%, there's regret. There's, I could have done that. And they generally follow behavior as opposed to preempt behavior. So I'm always cautious of following the trend and retail investors getting in before institutional investors. So, the answer to your question is, that doesn't surprise me. Rallies lead to retail flows, and unfortunately, sell-offs lead to retail sales. But why are we still cautious? To answer your second question, if you look at what actually was one of the reasons why there was a rally, U.S. Second quarter corporate results came out, and they were generally stronger than expected. But I think you got to realize that quarterly reports are backward looking. And when you're buying an asset and you're buying a share, you are buying the future profits of that company. The effect of high interest rates really hasn't been felt yet. And the effect of high inflation still hasn't been felt yet. So, those are significant headwinds that corporates and investors still have to face.
What happened in South Africa, though? Because the S&P 500 index, as you say, was up 9%. The NASDAQ was up 12.5% in July. South Africa, only 5%. We seem to be lagging.
Correct. And if you convert that in terms of dollars, we were up 1%. So, obviously the currency was an important factor there, where the US dollar continues to be the safe haven and appreciating against all other currencies. But I think the other point is, our market has a significant resource weighting. Commodity prices on the whole last month were a little bit softer. Our resources index was flat. So despite global markets being up 9-10%, when you've got a significant portion of your equity market being resource basic materials heavy, well, that answers why we lag international markets.
That's an interesting point then. So South Africans shouldn't really take too much attention or pay too much attention to this next question, which is when the experts look at market turns, they reckon there always has to be capitulation before that happens. In other words, desperation, a time that nobody wants to buy shares again, and only at that point does the market turn. We haven't seen that yet.
No, we haven't, especially after the rebound. We're certainly not there now. But I would say if you rewind the clock to last month this time, there was some element of capitulation. You had not only equity markets off to, as you said earlier in the interview, off to one of their worst starts in the year, but you also had bond markets, which, you buy for stability and for decorrelation. That was off to its worst start in many, many years. So, time sort of heals. Last time this month, I think there was some element of capitulation. But as we said earlier, markets up 10% from then and the world looks a little bit rosier.
Okay, so now you need to give us some insight into who you would reckon is one South African equities manager who's done well enough over the past few years for us all to be paying more attention to.
So, it's a great question. At Corion, we believe investing is not a fast fashion. It's not about constantly changing and chopping. It's about sticking to your process and making sure you follow what over the long term you think is going to work. And I think I'm going to mention a name that I think sticks to those principles, and that is Clucas Gray, led by a manager called Andrew Vincent. We have had exposure to Clucas Gray for some time now, and it hasn't been a one-way bet. COVID, I think, admittedly to him, caught him by surprise. I don't think many people, forecasted such an event, and his portfolios really did suffer. But through that course and that pain, he came to present to us and presented why valuations are so compelling, stuck to his guns, and certainly, didn't panic. And the next 3 years or 2.5 years certainly has rewarded our clients for his investment views. So not a common name, but I think a small manager who sticks to his process, who's got a good track record, and something to watch out for people out there in the street.
Nice one. And I've heard of Andrew Vincent before. He is highly rated. He's one of those managers, beneath the radar, as is Cy Jacobs. And Piet Viljoen is above the radar at the moment because of his great performance. Now, Cy and Piet are going to be debating at the Business Conference, which I know you're attending. I think that's something a little appetizing, isn't it? Mouth-watering in many respects. For the one, a value manager, the other one, more of an opportunist.
And I think also the one a little bit more concerned about the future and the one a little bit more rosy about the South African future and equity valuations. So that will be an interesting debate. Two very good managers, two managers who have got a good track record of sticking to their guns, as I said earlier. Piet, for example, was probably way too early on the platinum rally. But, if investors stayed the course, they would have benefited from that. So looking forward to the conference.
It's an interesting point you've made that now with Andrew Vincent and with Piet Viljoen, the staying with it with an investment manager through the cycle. Does that generally pay off?
We believe so. I mean, you got to go back to the reasons why you invested in a manager. If you believe he has ability, if you believe in his process and his philosophy, you shouldn't manage or judge that manager, over a 6-month period, a 1-year period. Accidents happen, mistakes are always made in investments, but you got to judge a manager on a longer term track record and through a cycle, in our opinion. If you believe that at the time of investing, those reasons are still valid, then, and that's even ignoring the costs that you're going to use by firing a manager and hiring another manager, then we think it's prudent and wise to stay the course. And that kind of contrarian approach, which in many instances is what I think retail investors don't do. I think the smarter money, if you stay in that process, you generally leads to outperformance.
You're getting a nice group of people, certainly within the business community, who are following your thoughts, not least because of statements like last month, where you said you're nibbling again and you felt that prices were starting to look, or values were starting to look appealing. How are you reading it right now after that big rebound?
I think be cautious. As I said earlier, to be underweight, I think you need a stronger argument than to be overweight, because the law of averages, markets go up, risk assets to reward you. But we do have headwinds. We are having lower economic activity and valuations, which is critical. And I'm talking globally and probably specifically the US, are not cheap. So, don't get caught up in this rebound. Be invested in what you think will outperform over the long term, which I do think is equities. But certainly, I wouldn't be going overweight equities, if you had to really press me for an answer.
And then be aware that there could be pullbacks. Not every month's going to be July.
Correct. I mean, I think the short-term volatility is actually a long-term gift. If you don't have the volatility and you can't stand the nature of markets, then you're not going to be rewarded over the longer term. So if you look at things on a daily basis or weekly basis, I think it creates a lot of noise. You've got to really have your eye on the long term on what you think will play out in a year, 3 years' time in terms of valuations, economic cycles, and the less attention you pay for a 1 week, 1 month period, probably you're better for it.
And I suppose that brings you, if you are interested in that kind of thing, to an asset manager like Cy Jacobs, who does look for those opportunities. But that's all he and the 361 team do 24/7, unlike most investors who've got a day job to worry about.
Correct. Investing isn't an easy game. It's a humbling game. And I say the word game because it's, you are, at the end of the day, probably game's the wrong word. You're looking after the savings of your clients. And that's a significant responsibility. So you're going to hopefully get your decisions more right than wrong. And if you do that and your clients are patient with you and believe in you, then generally, your clients are better for it.
David Bacher from Corion Capital looking at the Corion Report.